Today, words matter in a fractious, overvalued market. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the Fed has to balance full employment and stable prices. Today we got the signal that the latter, rather than the former, is now set to take centre stage. This is significant to say the least when market values are bloated thanks to money printing and inflation fears are rife despite the unknowable impact of Omicron. This is significant for the US and for global markets as well as our own market. Federal Reserve Chair Jerome Powell made comments on Tuesday before the Senate Banking Committee, where both Democrats and Republicans expressed concerns about high prices, and they were taken as a hawkish pivot by financial markets that could deliver sooner than expected increases in interest rates next year. The hawkish tone in Powell's testimony today, along with the speech from other FOMC members in the past weeks, signalled a fundamental shift within the committee when the Fed's dual mandate of price stability and maximum employment comes in tension with one another. The central bank will place more weight on the first one, said Bloomberg.
Particularly since the November FOMC meeting show elevated inflation pressures, a rapid improvement in many labor market indicators without an accompanying addition of labor supply, and also strong spending that really signals growth, significant growth in coming months. Remember that every dollar of asset purchases actually adds accommodation to the economy. But at this point, the economy is very strong and inflationary pressures are high, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting, perhaps a few months sooner. And I expect that we will discuss that at our upcoming meeting in a couple of weeks. Of course, between now and then, we will see another labor market report, another inflation report, and we'll also get a better sense of the new COVID variant as well before we make that decision.
Powell, in his opening remarks, said that the recent cases of COVID-19 and the emergence of the Omicron variant pose downside risks to employment and economic activity and increased uncertainty for inflation. But during the following question and answer period, the questions and his answers focused more on the accumulating evidence of elevated prices since officials met in early November. He appears to have retired the word transitory to describe stubbornly high inflation, though a new COVID-19 strain remains a risk. Powell said the word transitory was supposed to signal a blip in prices that wouldn't leave a permanent mark in the form of higher inflation. That view was largely based on the idea that inflation resulted from supply disruptions on everything from goods to labour. But scarcities of both are taking longer to resolve, Powell said, in both his opening remarks and in response to questions. Most forecasters, including at the Fed, continue to expect that inflation will move significantly down over the next year as supply and demand imbalances abate, he said. It is difficult to predict the persistence and effects of supply constraints, but it now appears that factors pushing inflation upward will linger well into next year. It is appropriate, I think, for us to discuss at our next meeting, which is in a couple of weeks, whether it will be appropriate to wrap up our purchases a few months earlier, said Powell, who, of course, last week was selected by President Joe Biden for another 4-year term as Fed chief. In those 2 weeks, we are going to get more data and learn more about the new variant. Powell's comments mark a rare moment of pre-positioning by a Fed chair, which signifies he probably has already got broad support on the FOMC to cut back asset purchases. Policymakers, including Governor Christopher Waller and Fed Presidents Mary Daly of San Francisco and Raphael Bostic of Atlanta, have all said they will consider a faster pace of tapering if economic data remains strong. The bipartisan support during the hearing for more forceful action on inflation also gave Powell political backing to speed up the taper prior to a vote on his second term as Fed chair. The US Central Bank is currently scheduled to complete its asset purchase program in mid-2022 under a plan announced at the start of November to slow buying by $15 billion a month. The next gathering of the policy-setting Federal Open Market Committee is December the 14th and 15th, where they could make a decision to accelerate the tapering. Powell called the sideways movement in labour force participation surprising, noting that officials thought that with the end of extended unemployment benefits, rising vaccination levels and schools reopening, more people would come back to a job or look for one. We all thought there would be a significant increase in labour supply, and it hasn't happened, he said. He'll get an update on that in Friday's jobs reports. As a result of all this, stocks fell and the US Treasury curve flattened as investors digested the remarks. Fed officials have consistently said they want to wrap up the tapering before increasing borrowing costs from near zero, where they've been since the onset of the pandemic in March 2020. Traders boosted bets on how quickly the Fed will raise rates on the back of Powell's comments. It now looks like it will take a deterioration in the public health situation over the next 2 weeks to prevent the FOMC from deciding to quicken the pace of tapering at the next meeting, JP Morgan Chase said. Turbo tapering is on the agenda for the December FOMC. And the Labour Department reported stronger than anticipated job gains for October, followed by data showing the biggest increase in the consumer price index in 3 decades. Since the last meeting, we've seen basically elevated inflation pressures. We've seen very strong labour market data without any improvement in labour supply, and we've seen strong spending too, Powell said. And remembering that every dollar of asset purchases does increase accommodation, we now look at an economy that is very strong and inflationary pressures are very high. The S&P 500 slumped on Tuesday after all of that, as well, of course, reflecting on the Omicron variant. The S&P 500 fell 1.9%, the Dow Jones Industrial Average fell 1.9%, and the Nasdaq fell 1.6%. I think it's healthy to see Powell recognising that inflation is real. It's not just coming and going, but part of the fabric of the global economy right now, said Eric Ditton, President and Managing Director of the Wealth Alliance. The Fed should taper faster. I scratched my head as to why they're buying the current volume of bonds every month when we're seeing inflation, strong earnings and very strong consumer demand, he added. The update from Powell rattled risk sentiment as it arrived amid uncertainty about the impact of the Omicron variant of coronavirus, of course. The Moderna chief executive warned of a material drop in vaccine efficacy against the Omicron variant, and Regeneron also added to fears about the virus impact after saying its COVID-19 antibody drugs could be less effective against the new variant. Its shares fell more than 2%. The volatility index was up 18.42% to 27.19. Gold futures for February delivery was down 0.5% to 1,776. WTI crude oil for delivery in January fell 4.3% to 66.94, while the euro-US dollar was up 0.04% to 1.1341. And the US dollar futures index was down 0.45% to 95.90. And finally, Bitcoin was down 1.38% to 57,335 as we write this. So standing back, I think we can conclude that uncertainty is now very much in the centre of the case. And with the Fed now looking probably to lift rates sooner, this could have a very significant and negative impact on the markets in the medium term. Of course, the question will be whether the Fed gets cold feet if markets start to slide. That, of course, has stopped them previously doing the things they should be doing. But this time, with inflation so high, and probably sticking at that for some long time, the chances of the Fed doing what it says it's going to do probably are higher. And as I said, as the title of this show, words matter. And that means that we could start to see some significant corrections in markets ahead. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.